We kick off our Jackson Hole coverage of the Federal Reserve Conference, as we always do, with an interview with Kansas City Fed President Esther George. This is her 10th Jackson Hole conference as Fed President, and unfortunately, the last one, we understand.
Yes, it is.
Well, thanks for joining us as always and agreeing to sit down. I want to start off where I think the market is most interested. It's been an aggressive series of rate hikes, and maybe you could shed some light on perhaps how much more there is to go.
So I think when we look at the economy today, Steve, we still see imbalances between demand and supply, and that's putting high inflation in play. So we still have high inflation. We saw some easing in the July numbers, but I think it remains broad-based, so there's more work to be done. Some
of your colleagues have said they see a sort of terminal rate of 3.75 to 4%. Others have said above 4%. Which camp do you put yourself in, or neither?
Well, I think for this year, we have 3 more meetings. We know we still have more progress to make, and what I'm really looking for is to say, when do we see the turning point in inflation? When can we begin to see where that terminal rate might rest? Because I don't think we know yet where that may have to settle out, but it will be higher than it is today for sure.
How will you know it when you see it?
So I think you'll see a pretty convincing deceleration in inflation, and I think for me, I will be hearing it in the region. So one of the early indicators for me is always talking to our business contacts, to people in the community, to get a sense of what they are experiencing and where they see that over the next 6 months.
Do I take it you're not hearing it now?
I am not hearing it now.
What are you hearing?
So right now we continue to hear number one concern is a tight labor market, difficulty finding people to work, and that price pressures are still there. They've seen some easing, I think, on supply constraints, but not enough that they can look ahead over the next year and think that isn't still going to be an issue for them.
Is it 3 months in a row of good numbers like we had in July? Is it 4 months in a row that'll give you some confidence?
Well, ultimately, it's getting back to our target. And so I think to see a convincing trend, you'd want to at least see 3 consistent months of data to know where things are. But of course, always doing that in the context of what's going on in the rest of the world, what else is unfolding in our domestic economy at the same time.
The market gets obsessed about things like 50 or 75. Do you want to weigh in on what your preference would be for September?
No.
Great. But what is the difference in your mind? If you did 50, what are you signaling? If you do 75, what are you trying to accomplish? How do you understand the differences between the two?
Yeah, I think that's hard to explain. Obviously, doing 75 in June and July sets a pace that I think the public is looking for, what changes that would cause you to step down. And I think certainly at some point getting to a steadier, more sustainable pace is going to be important. So I think it's too soon to say, you know, what should we expect in September, because we have some important data that's coming up, and always for me an important conversation around that table about what other people are seeing.
Could it be more than 75 in your mind, or less than 50?
Well, I think after we saw July, I think the real question is, does the July inflation numbers beginning of seeing other easing that will come in months to come? But far from clear, given how broad-based inflation is right now.
You dissented on a recent vote for a very specific reason. It had to do with the relationship between interest rates and the balance sheet and the effort to reduce the balance sheet. Can you explain that? Do you still have those concerns?
So when I think about the process of removing accommodation and beginning to tighten policy, obviously the short-term interest rate has been our primary focus. But we also have a very large balance sheet, and our commitment has been to bring that balance sheet down. And of course, we will be doing that in a much more volatile environment, more uncertain environment than we did in 2017, the last time we did this. And so as I looked at the path of rates and thinking about the intertwined effects of a balance sheet, it makes me just watch things a little more closely to see how the markets respond, to see how financial conditions respond to that.
Do you still have concerns that raising rates by 75 basis point increments could endanger the effort to reduce the balance sheet?
Well, we certainly have done a lot of interest rate increase in a short amount of time. Nothing I've seen in my time on the FOMC. And I think we should still expect that some of that policy will work with a lag. So we've seen it hit the housing market pretty quickly, but I think its full effects may not be seen for some time. And so keeping that in mind as we move forward with this very expeditious path of rate increases is particularly important to me.
The balance sheet is not rolling off quite according to a schedule. I know there are things that make it go up and down and not be perfect, but are you concerned at all? I see there's a $116 billion reduction since you began in June or so, and it should be $150 billion by the end of this month. Is that close enough, or is there some problem that you're having in terms of reducing the balance sheet?
So remember, the caps are being implemented, phased in, if you will.
Right.
And so they will hit their full effect in September in terms of bringing down the balance sheet. So it is a faster pace than we've done before. It is a larger balance sheet than we've had before. But I think we'll have to see how the market adjusts to that.
It's not just the market, but it's the actual pace of the decline. Should it be hitting a certain amount every month, or is it going to be plus or minus because of different idiosyncratic elements?
That'll be a function of the maturities as
Okay.
they roll off. And of course, we've made a commitment to a significant reduction in that balance sheet and getting back to a mostly treasuries portfolio.
Right.
So there's work to be done on the balance sheet for sure.
And how about selling assets? Is that something that you favor?
I think it's going to be necessary at some point. Particularly given that we're in a higher rate environment, to get back to a treasuries only portfolio may require making some adjustments there at some point.
I want to talk a little about the inflation process. How do you expect it to cool? Do you think, is it housing that comes down, or the housing price that comes down? Is it consumer spending that comes down and eases off on the pressure on consumer prices? What's the process in your mind?
So I think the process we've seen a little bit of already. So we've seen in the housing some cooling beginning at that point. I guess when I look at the inflation dynamics right now, though, we have a fundamental imbalance still between supply and demand, and it is very broad-based when we look at the drivers of inflation right now. So what we saw in July, we saw some airfares coming off there. We saw hotel accommodations, car rentals, those kinds of things. But those were pretty specific categories. I think we're going to have to see something more broad-based to begin to know that inflation is coming off its highs.
Does the unemployment rate need to rise to bring down inflation?
So the labor market is very tight. And I suspect to get some loosening in that labor market, you will see higher unemployment.
That leads to the next important area here. It's really a three-part question. First, I'll give you the first two parts now. Is it already a recession, or will it be a recession?
Yeah, so it's an interesting question that comes up because, again, when I talk to contacts in my region, the things I hear would not be consistent with what you might hear during a recession. Difficulty finding labor, a tight labor market, wages rising, adding jobs every chance they get. So that dynamic is not clear yet, despite the fact that we had 2 quarters of negative GDP and added 3 million jobs. So it is an unprecedented kind of situation when you think about recession dynamics. What
does Esther George, the Kansas City Fed president, say? Is it a recession?
I think what we see right now is demand is cooling.
Yeah.
And I'm going to be watching that data very carefully to see how much it brings this imbalance back to something to get inflation down.
If it is a recession, this is the third part of the question, how does that change policy? Or does it?
Well, I think there are always factors that are going to influence our policy that we can't anticipate. For right now, given the dynamics we see in the economy, our charge is pretty clear, and that is to bring inflation back to our target. And that remains the focus, even as we watch what's going on around it. And right now, that seems pretty clear on the path ahead.
So just to kind of understand that sequence, if it seems like it's a recession and the growth is negative and unemployment rate is rising, that wouldn't necessarily change policy if you're still above target.
Well, when you say, for example, unemployment rising, we're at 3.5%. If we think about a natural rate of unemployment, if we think about what I might have penciled in my own forecast, it is well below that number. So you could see unemployment rise and begin to provide some easing there, along with other dynamics in the economy. And it's just hard to predict which one of those will end up being the stronger factors in bringing inflation down.
The title of the conference is Constraints on the Economy. Can you give a preview of what kind of topics that leads to the discussion?
So I'm looking forward to this conference because we're going to talk about reassessing constraints in terms of how we've thought about it over the past couple of decades. So over the past few decades, as you know, the issue has really been, do we have enough demand in the economy? We had relatively low inflation. We now are focusing more on supply. and what a supply shock has done, the inflation that's accompanied that, the kinds of policies that have come along the past 2 years. So I think it's a good time to revisit those constraints as we've talked about them in the past and see what it means in the current environment.
When we talk about those constraints, you talked about some of them already. One of them is labor, another is supply, and that's globalization. Do you think we're entering a period, is it possible we're entering a period here of higher inflation because the things that kept it down in the past are have gone away?
Well, I don't know if they've gone away. I think the question will be, we've talked a long time about demographics and what effect they've had on long-term growth in the economy. So I think the question is, what else is going on maybe that we weren't thinking about? What other factors? And I think that's what will be interesting in this conference, is to hear perspectives on what's changed, what have we not paid attention to that we should pay more attention to now, and what role has policy played in any of this that might change how we thought about it?
I want to get to that in just a second, which is really important. But if it is a world of more constraints on supply, more constraints on the supply of labor, the supply of goods, does that mean a world of higher federal funds rates?
It could mean higher funds rates. Right now, we're looking at inflation and trying to decide how sticky is inflation. It's so broad-based now, what will it take to bring that down? And so I think for the near term, anyway, thinking about higher interest rates seems reasonable to me. Whether in the long run, again, I hope this conference sheds some light on that.
You talked about policy. The Fed chair, others have acknowledged there were mistakes made along the way. I don't think we need to go over that ground. I guess the question I have is, if mistakes were made, is there an examination process of how to fix it such that they're not made again in the future?
I think that's always important for the central bank. And as you know, Steve, we've had a process that created the framework that was put in place a few years ago, the idea of periodically taking a look at how we set policy, how those strategies are fulfilling our mandates in doing that. So I suspect over the next few years, that's going to be an important component to look at.
But it's unfortunate that one of the things that's blamed for the mistakes that were made is the new framework.
Right.
The idea of waiting until inflation was obvious before you acted. Is that seen as a mistake, something that needs to be looked at again?
So I don't think I wouldn't put the burden on the framework. I would put the burden on the experience we've had the last 2 years. This was an unprecedented kind of shock to the economy. We didn't have a playbook around pandemics. We also saw fiscal policy responding in an extraordinary way. So I think there certainly will be things we need to learn from that experience in thinking about the role of policy, how we judged inflation dynamics over that period. But I wouldn't lay it at the feet of the framework per se, given the nature of what we've been through.
One thing that seems a little troubling is throughout the process, from the beginning of the easing through the extended easing while inflation was going on, most of the votes were unanimous for policy. Those unanimous votes, in retrospect, were mistakes. Is there a danger of a groupthink that needs to be examined at the Federal Reserve?
Well, you know, I think it's very important, and the committee process provides for the ability to bring different views to the table. You also know there's not a vote of the entire committee. So the voices that are at that committee, whether they're voting members or not, can affect how the public views whether the consensus was there. But I will tell you, being one that values having the diversity of views, the opportunity to dissent, is an important component of how this committee makes decisions.
It didn't happen.
It did not happen, and you know, you'd have to talk to everyone because it's a very individual decision how you come out on those. I will say it was a time of high uncertainty. Again, going back to, I don't want to overuse the word unprecedented, but it was, in terms of judging what was happening in the economy, whether this supply shock would be met, whether the demand would be met in some way. So a lot of retrospection to think about there.
Okay, so your 10th Jackson Hole conference as president, and you've been coming since 2005, which I think that's 17 years. What stands out in your mind, in memories?
Well, every one of these conferences is unique in some way, but I think the thread that I always walk away from is the opportunity to bring really intellectual rigor to some of these topics that are of importance to global central banks, to have that debate in the room, and then the opportunity in this beautiful setting to be able to continue that conversation throughout the conference. So that is, I think, always the highlight for me, is listening to that debate, listening to how people think about these issues, and coming away, I think, with a better understanding, hopefully.
All right, I'll give you mine, okay? I'll tell you two that I remember. I remember complaining bitterly about the demographics conference and using the information for many years to come and still today. The other one I remember from that same conference was when Alan Greenspan said, we don't know a lot that's definite about economics. We have no like given, constants, but we do know the vast number of people who are 35 years old now, in 30 years will be 65. That was one of my favorite clips. That when he told me to look at productivity. Anything particular anecdote that stands out for you?
When I think over this is our 45th symposium.
Right.
When you think over that span of time about how many things have changed, we had the Asian financial crisis, we had the Eastern European bloc beginning to come to the conference and raising issues about how they would think about monetary policy. So I think any number of those. 2007, we talked about housing finance, and a lot of people at that time said, what kind of a topic is that for central bankers to talk about?
Didn't somebody stand up and make a warning in 2007 that was kind of dismissed at this conference?
Yes, there was. There were questions about financial stability that actually came a few years earlier and actually turned out to be pretty prescient.
Anything else, Esther, that you want to add?
No,
everything?
I'm delighted we're back here in Jackson Hole again and the chance to engage in this topic.
Thanks so much, Esther.
All right.
Great. Bye-bye.